the real issues are, one, you've got the exact hit from the tariffs, from a economic perspective. What does that really mean? And I think, Mike, you're right. I mean, it's, in the context of a $16-17 trillion economy, it's not terribly significant. What it really is what does it do to confidence? What does it do to your ability to plan going forward? So are you going to invest in factories? Are you going to invest in workers going forward? Before we had this notion with tax reform, with deregulation, that it was really all systems go, the trade wars and this trade, the trade conflict we have is creating significant uncertainty. And if that's putting plans on hold, that is going to impact economic activity, that's going to impact markets, jobs, et cetera, that's a certain negative.
Yeah, but we don't see the actual numbers. We couldn't, even if we did, we wouldn't know whether GDP was 0.1 or 0.2 lower based on the trade wars or not. So we won't see that necessarily. How do we know when it becomes something the market should pay attention to? Because they always seem to rebound from a day like today.
So yeah, I would agree that you're not going to see it play out in the numbers, at least until it's really too late. But to my mind, the issue is relatively similar, right? It's an issue of confidence, and we have this corporate tax package, we have this 2-year budget agreement. I worry that coupled with the rise in the price in oil that we've seen so far this year, we could essentially be undoing all of the positive tailwinds for the economy that came into play, back in January. So I think we need to watch confidence very closely. And Mike, to your point, I think it's going to be a tug of war here between fundamental data, which comes out during the earnings calls over the next couple of weeks, and rhetoric coming out of the White House. This tug of war between policy and fundamentals isn't going away. I think at the end of the day, fundamentals win out, but we're being forced to reconsider what some of these adverse scenarios might look like as trade escalations continue, or trade talks continue to escalate.
There was a time when a lot of the economists that lean one way politically or whatever, they were latching on to, before the trade war, they were latching on to that we had thrown stimulus onto an economy that was too hot and to a job market that was already too tight, and this was the wrong time to do it. And I don't hear them anymore because the 10 years suddenly seems like it got a cap on it from the trade war. Is there anything to the idea that if there's ever a time to address China's intellectual property, the things that, the profligate behavior that they display there, or some of the other stuff, even in Europe, some of the tariffs that we feel are unfair. At the same time, you're, to Jason Furman, I'd say, Jason, you don't need to worry about, too much stimulus now and the economy growing too quickly. Why not do it now? Is there anything to that?
Well, look, I think if you're going to go ahead and negotiate, you want to negotiate from a position of strength. And the U.S. economy is strong and getting stronger. So clearly it makes a lot of sense that if you're going to go ahead and make this gambit, try to get fairer trade across the world and address some of the issues that we've had, you do it now when the U.S. economy is expanding, when jobs are plentiful. You've got employment growth that's extraordinarily strong, corporate profits. I mean, we're going to be looking at least a 20% earnings quarter year over year. You're going to deal with it. You want to deal with this type of the ramifications of this type of an action and the potential slowdown at a time when you're doing very well and you have plenty of offsets.
But I think the offsetting piece to that, right, is today everything's okay, and we kind of have this sugar rush in the U.S. economy, which should prop things up for the next 12 months. What does it mean longer term once we get out of this environment and we find ourselves with another trillion?
But that only matters if the tariffs are permanent. I mean, if you're of the view that the tariffs don't last for longer than 6 or 12 months, then this is more akin to a price spike or a price shock, right, in the U.S. markets, which is not a lasting thing. It's something that the markets digest, but eventually get past. So it's only if you are in the camp where the tariffs are permanent state of being where we have to deal with that.
That is very fair. I guess from where I sit as an economist, it feels a little bit risky to be having this negotiation with the expectation that everything will work out favorably just in time for economic stimulus to fade next year. To me, the stars would have to align nearly perfectly, and I think we're just, this is a bit of a dangerous ballgame that we're playing here. And if you look at the worst case scenario and model out what the numbers look like, you could see a full percentage point hit to GDP. You could see inflation higher by 30 or 40 basis points.
And that's with $500 billion.
And that's with $500 billion of tariffs, just with China not bringing into play the autos and
I mean, to me, it's about, does it create some kind of capital flight from emerging markets? Is the dollar rally a lot? And then you talk about a financial accident, not really just the cost of tariffs.
Yeah, but I think that's overblown. And I think that's part of the issue in terms of why markets are reacting so severely to this news, when on the headlines, it's not terribly severe. And that is, we're still dealing with the behavioral ramifications of a post-GFC world, where we're worried about a financial crisis all the time. And, you're now worried about a trade war causing a financial crisis. That seems extremely remote.
I wouldn't say financial crisis, just a little bit of disturbance in the market.
No, completely. But I think you've got markets somewhat nervous that you're seeing volatility spike when you get these kind of headlines. And I think we need to contextualize it. There's a lot of things that are happening that are good. I would argue that the tax reform and the deregulation are more powerful dollar for dollar than in the current trade restrictions that we're looking at, and that is long lasting. Those are supply oriented, tremendously positive long-term demand tools. And right now we've also got to deal with the fact that we have a president who likes to negotiate in public. It's a little different than what we're accustomed to, and so I think we need to probably adopt as a market, as market participants, a little bit more of a sanguine response when we see some of these headlines out there.
But I think, Mike, you make a good point. The dollar is going to be central to whatever happens in the back half of the year. If the dollar remains well bid, there's going to be a bit of a failure to launch in the rest of the world. The U.S. is still going to look very good, and I think U.S. equities can still grind higher. But if that dollar strength persists, I think it kind of tempers growth in the rest of the world and continues to desynchronize that recovery, which was just such a strong tailwind to asset performance in 2017.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.